This is truly an unusual time. We have unbelievably low volume. Most of the market moves happen overnight. The biggest buyers of stocks are the companies themselves, and the Fed is pumping money into the biggest companies in the world through their new programs. It's absolute madness on a historical scale. But I don't know about you, but I'm gonna party like it's 1999. You came here for the truth, so let me unveil that for you. Today we are going to look at what's happening. I'm going to show you many different factors here. There are the ups and there are the downs, and it does not make sense on any level. Let's get into it. Jim Cramer, as you know, he's a big proponent of buying stocks, but even he is suggesting that something is very, very wrong. Don't get too optimistic. Cramer says Wall Street records don't reflect Main Street struggles. But the reason I mention it is specifically this quote. We like the fact that the market is going higher because our viewers own stocks. Right now, we seem gassed. Isn't that interesting to hear this from Cramer? And of course, the advertisers are the ones who are paying all of this, making it happen. They have to constantly pump the stocks. They can't make it look bad, even when things are difficult. But you can see some of the cracks appearing today, and Jim Cramer is willing to admit that. One extreme example is Tesla. Tesla closes above $2,000 per share for the first time. It's now worth more than Walmart. You can argue about which company is worth what their market cap should be, what their stock price should be, but this to me shows how extreme we can have these times. But this just shows to me how extreme things can happen in these times, and there is no more apparent disparity than these two here. This is an issue that I've talked about many times before, but now that I have some additional information, wanted to bring it up to you. Out of the Washington Post, rising stock market would be in the red without a handful of familiar names. Please understand what it's saying here. Without that group of stocks, the market would still be in the red. And it's important because when you say, oh, the stock market, we have to look at it on a much more specific level. If I tell you that something is the way it is in the United States, there is rioting all over the United States right now. It's chaos. There are fires right now all over the US. It's crazy. Is that an accurate representation? Of course not. But when we look at the stock market, somehow we just generalize. Now, perhaps those people are buying into the ETFs and they're just riding the wave on the way up, but there's more to it than that. If somebody's doing that, there's nothing to do with investing when you buy into an ETF. You're buying the market. You're not timing it. You just keep putting money in. Whole different story. If you want to know what's underlying all of it, well, then we can look into the details. 500 companies make up Wall Street's most widely used measure of the stock market performance, the S&P 500. If it were not for just 6 of them, the benchmark would be down this year. That's the bad news. The good news is that thanks to these 6 high-flying stocks, including Apple, the S&P has powered through the problems of 2020 to gain almost 5% and set a record. Along with Apple, the overachievers, Facebook, Amazon, Netflix, Microsoft, and Google's parent Alphabet are household names that have leveraged digital expertise to prosper amid the new socially distanced reality. These 6 were up 43% this year, while the rest of the companies in the index together lost about 4%. Now, certainly they have come back up from their bottom. Let's be very clear. But the story is very different when you exclude just 6 names. There are extremes all over the place, and it is nowhere more apparent than in real estate in Toronto. This is the most overpriced real estate in the entire world if you measure it based on the average household income to the average house price. This right here is essentially a tiny home selling for $1 million. And if I'm not mistaken, don't quote me on it, it went for 1.8. This is of course in Canadian dollars, but it just shows you how excessive the market has become. Despite what's going on right now today, despite all the craziness, there is no slowing this market down until it pops. That's the danger here. Many people think it can go up forever. Nothing goes up forever. And that's the problem. It would be much better to see a market that every couple years it comes down by 5 or 10% and then it gets recharged. But instead, here is a market that is just consistently going higher. People are paying these extremes. There's so much fraud in the paperwork. Mortgage rates have to continue to go lower and lower. People are extending out their mortgages as far as they can, and it only makes a future crisis much worse. Movers in New York City are so busy, they're turning people away. There is so much of an exodus that's taking place in New York City right now. The moving companies literally cannot keep up. This article is also about New York and it's talking about how bad the crisis of 2020 has been. Apparently, it's worse than what happened in 2001 and 2008. The city's high-end market was dealt with an unprecedented blow. Can it ever fully recover? It is questionable right now what is happening to this place where you have rents at $4,000, where you have homes that are millions and millions of dollars, and yet they're little matchbox or shoebox size places. It's very interesting to see how it's unfolding. U.S. weekly jobless claims jump back above $1 million. So I'm trying to keep you updated on this. You might have seen it already, but you could see that in this case here, 1.1 million. They expected 923,000. Everything's always going to get better. Well, you know what? We don't need to worry because the Fed will be there to make sure that if anything does happen, they'll pump up the markets anyway. Continuing claims for unemployment insurance, you could see right here, week ending August 8th, 14.8 million. Yes, this has been declining over this period. It is down from its absolute peak, but the numbers are still staggering. Initial claims for unemployment insurance, you could see right there, week ending August 15th, 1.1 million. I'm sure with the benefits running out, people are unable to get what they need. Things are certainly piling up for them. Debt is increasing, problems arising. This comes from Wolf Street, where you have the continued claims not seasonally adjusted, and it's a whole different story. It shows you both the federal and the state claims, still quite excessive at 28 million. This is absolutely critical. Let's take a look at this report. The data was sent to Congress this week and compiled by TREP. It shows that the percentage of hotel loans 30 days or more delinquent is 23.4% as of last month, the highest percentage on record. By comparison, the percentage of hotel loans that were 30 or more days delinquent at the end of 2019 was just 1.3%. So this has soared. This has spiked. And just as I have told you 100 times before, and I'll tell you 100 times again, we have to pay particular attention to the commercial mortgage-backed securities. This is very integral to the financial system because these mortgage-backed securities are being sold off to investors everywhere. These financial companies are linked in with all of the different companies that you might be interacting with on a daily basis. They're sold off to people to make money off of, and then what happens if there's something that goes wrong at one of these hotels, they go bankrupt, they're unable to pay their debts. Well, then you start to have an unraveling of the financial system because they created something called a derivative, and it's absolutely crazy. It's absolutely ludicrous because what they highlighted back in 2008 was enough for us to understand that these are too dangerous to use, but here we are, it's getting worse. This does not have to come from the residential side. It can begin on the commercial side. It can begin anywhere, in fact, because derivatives connect it all. With record low travel demand, thousands of hotels can't afford to pay their commercial mortgages and they're facing foreclosure with the harsh reality of having to close their doors permanently. Tens of thousands of hotel employees and other jobs in the industry are at risk if federal aid isn't administered. So they want more money. That's the way it works all the time, and it's not going to fix the problem. Look at what happened with the airline industry. agency. Give us money, we won't lay anybody off. They give them money and they say, well, I know you gave us money, but we gotta lay them off anyway. And then what do? Don't lay anybody off, we'll give you some more money. It's just constantly being pumped out there. You know they're gonna have to lay people off. Delinquency rates within the commercial mortgage-backed securities market are at an all-time high. In total, 20 billion of hotel commercial mortgage-backed security loans were 30 or more days delinquent as of July. For comparison, the highest volume of delinquent hotel loans during the financial crisis more than a decade ago was 13.5 billion. We are at the start of the problem. This is the beginning of the problem. We have not hit the peak yet. This is going to get worse. They might get some bailout money, but as I said, how long does that last? Look at world trade right now. You can see the World Trade Organization put this out there. Goods barometer confirms steep drop in trade, but hints at a nascent recovery. Let's be very clear. It is nowhere near a recovery. There is no V shape in sight, except when you look at stocks like Apple. As far as I'm aware, this is the lowest number that they've ever recorded. This is showing you the extreme pessimism that's going on, but not in the stock market. Money's flowing in. Big difference today. Used vehicles. Now, this is a trend right here. You can see clearly at one point it dropped off significantly, but after that, month after month after month, it's been surging. Based on what I've seen, people are not buying those new cars, they're buying the used cars. They do not have the funds to do so. Additionally, they're buying used cars because they don't want to take the public transit. They don't want to be there with so many people around them. They feel uncomfortable, so they're buying a used car instead. There's also people that have been moving out of the cities, so they need a car, and perhaps they're choosing to buy a used car at this time. Interesting trends to see, no doubt. Apparently, Airbnb has decided to ban parties because there's some problems going on. The ban caps house occupancy at 16 people. I don't know if anybody's going to follow that rule, but just thought it would be interesting to point out. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. Thank you very much. If you want to learn how to sell stuff online, you can do so for free at the AmazonGPS.com. The financial system is complex and convoluted, but in these two books, I teach you everything you need to know to ask the right questions. You can check them out at the link in the description. If you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. You've got to watch this video. Have you seen it? Have you seen it? If not, definitely click on it. See you there.